All right, everybody. Hey, hopefully you're doing well this evening, this afternoon, or this morning, whenever you're watching this, whether you're watching this live with us on Zoom, on Facebook, catching the replay on YouTube, or on our podcast. Welcome to tonight's episode of the Note Nation Top 42. Tonight, we roll into the Emerald City of Seattle, Washington. We'll be talking about the markets there. I want to thank you for being here with us and watching this. I encourage you to ask questions, whether this is live or you catch this on the replay. Please feel free to type in your questions and somebody will be glad to answer it. More likely it'll probably be me or one of my staff members. But anyway, Note Nation, we're excited. This is the 8th city of the Note Nation Tour. We're a fifth of the way through our top 40 markets across the country, and we're excited to be rolling into Seattle, a beautiful city, a city that I enjoy visiting, not only just for the sporting events, but the food and the people as well. So if you're joining us for the first time, welcome to the Note Nation Tour. We have local and national investors across the country tuning in to watch what we'll be talking about tonight about the Seattle market. A lot of existing real estate investors joining us, some debt investors, some commercial investors, but also new investors looking for information on where to begin and what they can be expecting in Seattle over the next 6 to 12 months. We'll be discussing statistics and the numbers of the market right now, what people could expect, what we're seeing. We'll talk about the second half outlook, along with some future opportunities, where to look and when to get started if you're going to be investing in and around Seattle, Washington, and what it holds for investors out there, like I said, in both residential and commercial space. But for those of you guys that don't know who I am, I'm Scott Carson. I'm an active real estate investor since 2002, almost 20 years of investing experience. Hard to believe. Time flies when you're having fun, but a big background in the finance, mortgage, debt market since 2004, so over 16 years experience in that space. I've bought over $500 million in debt for our own portfolio. I'm the CEO of WeCloseNotes.com, Inc., which is our website. Obviously, WeCloseNotes.com for more information. But I've been teaching real estate investors since 2010 in a variety of fashions in the debt space. I've been teaching investors actually longer than that for over a decade, but solely focused in the debt space. Been investing in debt since 2008. I'm the host of the podcast, the Note Closer Show podcast. It's just a small little podcast with a couple million listeners each month. But I invest all across the country in roughly about 30 different states. But Austin, Texas is home. And why am I doing this tonight? Why am I spending time with 40 hours of my life, more like 120 hours of my life over the couple of weeks to really focus on the top 40 markets? Is because I love to help investors. 10 years ago, I sold everything I owned, jumped in my truck, and started driving around the country to meet with investors and identify markets and opportunities across the board. I love helping investors. I really enjoy helping people solve problems, and not just people on the investor side, but also borrowers, banks. People are looking to make a switch, and what their focus is as an investor. I love helping people solve problems. That's one of my love languages, is being the problem solver. I also do this because I believe that this is the opportunity that many people have been waiting for. 2008, 9, and 10 was and through 11, 12, 13, 14, 15, amazing opportunity that not everybody took advantage of. And if you've been sitting here kicking yourself because you didn't do more back then, now is the time to take action and start learning, honing your craft, developing those connections, developing those skills so that here in 90 days, 120 days, new year, that you're ready to rock and roll when a tsunami of deals start rolling in before then, obviously, but also after New Year's Eve. We want to make 2020, which obviously has been kind of a shit show for a lot of people, we want to make it the springboard to success for many investors in the new year. I also am a big fan about helping people out because I was once a distressed borrower back in 2002, 2003. I faced foreclosure. I faced defaults and forbearance agreements when some bad things happened to me here in Austin, Texas. But I was able to pull my ass out of a sling and learn from my experience, connect with other people, and always springboard me into a lot of amazing opportunities that I took advantage of. And I want you, if you're watching this or listening to this, you to be able to do the same thing too if you're struggling. I don't care what your story has been. You have the opportunity to take action and make some things happen. And then I'll tell you, there is no greater feeling than helping someone overcome an obstacle or achieve a goal or dream that they thought was impossible. And there's a lot of people out there that are struggling. They're facing the impossible things. Their dreams have turned into nightmares. They've been laid off. They're struggling to make payments. And I want to help people stay in their houses. I want people and investors to create win-win scenarios for everybody involved. So I have a goal of helping 10,000 investors in the 12 months. And our big mission is we have at WeCloseNotes.com, the podcast is we help investors to accomplish their dreams and increase their wealth through debt investing. And I want to do that for you guys. I want to help you at, if you're new to note investing, you're new to this, hey, hopefully it's your first step. If you're new to what we do, hey, you should know that we really have your best wishes in mind. So what do the national numbers say? You know, are they positive, excited? And a little bit more on the sad side, I would say, out there. When you look at national numbers, 11.1% unemployment rate in June 2020. That number is sad. So basically 1 out of 9 people are unemployed. 17.8 million people completely unemployed right now. That number, I think, is going to go up. It may go down a little bit, but it's varied as the states open up, great, but then as they also shut down, like we've had that happen here in Austin, Texas, unemployment rate is continued to jump back up. 52% of small businesses are expected to fail here this year, if not more, as this drags out in a variety of different cities and states across the country. The sad thing is that before all this kicked off really in March with Corona, 1 out of 10 homeowners was already struggling to stay current. 1 out of 10 homeowners already across the country were already roughly about 30 days behind. Now, right now, nationally, we have a 7.76% default rate, where basically 1 out of 13 mortgages are in at least 90 days in default, delinquent. That's not a good thing for anybody, whether it's in Seattle or Washington State or all across the country to Washington, D.C. There are 4.1 million Americans currently in default. Now, hopefully there's a lot of opportunities for them to stay in their houses, and we'll talk about a little bit of that later on. But in comparison, if you look at the numbers to the last Great Recession we went through 12 years ago, when it started in 2008, it took us 18 months to get to 1.6 million defaults. 18 months to get 1.6. We're 2.5 times that amount already in what, a sixth of the way? So this could be a whole lot worse. Obviously, some of the things that stepped in to drag it out, to kick the can down the road, to stretch this out a little bit, but we are seeing some serious numbers as we sit right now. So do yourself a favor, whoever's saying that, hey, we're in rosy or perfect stuff, that's not the case. People are waiting. Banks are sweating right now and thankful that the government has bailed out some people. But if they don't continue to step up and do some other things, it's going to be an ugly time, because we're seeing record spikes in loan delinquencies. And here's one of the things we're going to look at. Subprime has been back, but subprime's gone again. But it's now non-prime. Non-prime loans experienced a 21%, almost a 22% increase in defaults. You had prime loans, traditional normal mortgages saw a second highest increase at 12.2. Reperforming loans experienced a 6.4 annual increase in defaults. And then your prime loan delinquencies, your traditional 30-year fixed, that saw a 5.5% increase. So that's scary. All those numbers are higher than where we were. We were at 2.3, 2.5 at the end of last year. We've tripled our default rate. Okay? And if you look at where we're at here in Seattle, in the state, I got this as state. This is Washington State as itself. You can see Washington State went from 16.3 in unemployment rate down to 15.1 in May. That's good. Don't have the June numbers yet. Should have them hopefully shortly, but this is the Bureau of Labor Statistics. So that's the thing to look at. We went from in March 5.1 to 16.3. Wow. Okay. Washington State's at 15.1%. Now, if we look at Seattle itself, 16.1, almost tripled in April, and then we dropped to May to 14.8. That's good. That's going the right way, but that's still a tremendous amount of people being unemployed. So if you look, Seattle is a little bit below the state average there, but way up compared to the rest of the country in a variety of ways. Okay. So let's look at the foreclosure numbers there a little bit, because you're going to see people obviously that are unemployed, that continue to stay unemployed. Yes, they've got a 6-month forbearance agreement. Banks are delaying things for 6 months. What's going to happen if this continues and they don't have companies to go back to? There's no bailout further by the country. It's going to get worse. And no, I'm wrong. Seattle's been a great market. Seattle's actually had a very kind of one of the lowest rates of default in the country prior to this. In Seattle, one for every basically 12,000, 13,000 home borrowers is in default. That's not bad. That's pretty low. But the worst counties, 98136 is one in every 7,800. Okay. You definitely, if you look at this, the color coding of the light blue to the dark blue, there's not middle blue here anywhere. It's either the haves or the have-nots. And these are the zip codes that are seeing the biggest amount of defaults. So if you're in Seattle, depending on where these zip codes are at, they could be good things, they could be bad, depending on what you know in your market. Okay. Now, if you look at the current number of distribution of foreclosed based on the number of active foreclosures, obviously that number went down from April to May. 80% auctions, 20% bank owns. It's up, obviously, on bank owns the prior month there, which is kind of scary. Looking at the stats, you can see obviously had a peak in December. January dropped, and then it was peaked a little bit up in February, and then we've been on this obviously downhill since they kind of suspended everything in March. All right, it's down month over month. Bank owns up a little bit, 0-0 prior month, prior year. It's obviously slowed down some because, hey, Seattle's been a strong market. All right. And you look here, you can see the numbers as far as the number of total foreclosures obviously peaked in December there of last year, dropped and started to increase up. But then when they hit, it started dropping down. Don't be wrong. Seattle's an expensive place to live. We all know that. Are we going to see this number pick back up in June, July, August, September, October? I think we are. Now, here's the thing that scares the heck out of me. This came out May 1st. Seattle area mortgage delinquency rose 3 times faster than the U.S. average as coronavirus crisis grew. Yeah, it had a 3 times faster in Seattle compared to the rest of the country. Now, that's not a good thing. Obviously, delinquency rose, and the bank stepped in. Oh, wait 6 months. You won't wait 6 months. We know Seattle's always been that kind of pretend and extend mentality, not just on the mortgage side, but on the landlord with defaulted tenants that aren't paying. It's been a bad time. And so here's the thing I wanted to pull up there is the number of Seattle basically increased 11.4% month over month, nearly 3 times faster than 3.3%. That was back in March. A lot of those people are still in default. Okay. This is the beautiful thing is that in Seattle, you have some of the lowest rates of mortgage delinquency in the country. The data shows just 1.62% of Washington households are delinquent their mortgage in foreclosure compared to 3.39% nationally. That was back beginning of further in the year. All right. Delinquency rates have usually fallen at 10% in March. That's not the case, but here you go. You can see the number grew more rapidly here than in the nation as a whole. So that tells you, yeah, one of the lower foreclosure rates, but also delinquencies are 3 times faster. Obviously, we know Seattle was an epicenter for a lot of stuff that was going on, taking place. But here's the thing that's kind of kicking the hand down the road. As of April, 3.85 million homeowners were in forbearance. That number is actually closer to 4.6, 4.7. But that's, a lot, over $841 billion in unpaid principal. A lot of defaulted debt out there. And one of the nice things, applications for mortgages were down over the week, when mortgage applications were down 45% from last year. We know fewer people are applying for mortgages and they're not going out buying. Let's talk about foreclosures that pandemic. Here's the chart that I was talking about that gives you an average. You see Fannie on the top in green. You see, FHA. You see VA loans in the purple. You see conventional mortgages in the brown. All loans together roughly have that 4.36% on the conventional loans, but it's gonna get worse. We see this inching back up. The numbers for June haven't come out yet. Obviously, forbearance numbers continue to retreat as they drop a little bit as people are going back to work as best they can. But as things like, we know the numbers have increased here in Texas. We've seen them increase in other parts of the country too, as people aren't recovering. And that's what I talk about here, active forbearance plans. Yeah, people can't continue to be on forbearance if they don't have jobs to go back to and they can't afford what's going on. So let's talk about, is this good news or bad news for everybody? What do you think? Well, it can be good or bad depending on which side you're in. If you're in default, it's bad news. All right. If you're an investor, this can be good news for you if you've got the right skills, you've got the right niche that you're focused on. Roughly, if you look at 1.62% originally in Seattle, it's about 1 in 50 borrowers in default, about 1 in 52, 53. Here's the thing. Washington State is the lowest default state in the country as a whole for the most part. That's a good thing. But when you look in the longer FHA foreclosure timeframes, Washington to foreclose in Washington State, it's a judicial foreclosure 630 days. Yes, longer foreclosure timeframe, it's going to stretch out the foreclosures. You're not going to see REOs, you're not going to see foreclosed homes with a backlog of forbearance agreements and a backlog in a judicial foreclosure timeframe for 12 to 18 months. It's going to be a while before REOs hit the actual market for the most part. And the reason why we talk about FHA, because that is the biggest amount of impact. People in an FHA loan, for especially a lot through last year, were getting their down payment paid by the banks and also closing costs paid by the bank. Walking to a house, 100% down, no skin in the game. And now they're hit being budget mindset, a lot less income coming. So are they going to pay their mortgage? Are they going to pay for food or the utilities? Which way is going to get paid first? I think we can answer that. And then you add in, really, I like to say insult to injury. The Seattle, this scares me. The city, the management, the government of Seattle has even stretched out worse for if you're a landlord. Their 6 months, eviction protection for stopped in June, and they extended it another 6 months. So basically, people can live rent free for another 6 months to the end of the year if it was Corona or COVID related. Now that doesn't mean they get away without paying, but still, that's 6 more months without investors getting rent payments. And when the banks stop delaying forbearance agreements for borrowers, especially investment style loans, you've got to turn to something. So we're going to see a huge wave of smaller landlords, especially in Seattle, look to sell their house or selling their investments. It actually stays in the article that, hey, small investors are going to say goodbye. They were trying, one of the guys was trying to do a great job, say, hey, if you got less than 4 properties, let's not make that available. No, they made it all the way across the board, 6 months for everybody. Hey, you don't have to pay your rent for 6 months. That's not a good thing. It's a bad thing. Commercial debt, obviously, we see this happening across the space. You're going to see a lot more for rent signs. We talk about 52% small businesses predicting to fail. We know that number is actually going to increase the longer this stuff goes on, the longer we see spikes across the country. Seattle's already been dealing with a lot with this stuff. We know that the commercial market's been overpriced, I'd say, for the last 24 months for the most part, especially on the multifamily side. Apartments been overpriced. But you're going to see a lot of rent signs hanging out there. I think you're already seeing that in there. Some of the commercial default numbers, 1 out of every 5, 20% of every hotel loans are in default. Not just defaulted. All right, we know hospitalities, vacation, any type of service industry has really been struggled. We know that with the retail loans have been on life support, whether it's a strip mall or you've got a big box store, I think, or in malls, 1 out of every 2 malls are probably predicted to close in the next year or two. We know office vacancy is set to increase to 20% roughly. That's a vacancy factor. That's also increasing the amount that rents are expected to drop. You're going to see a 15% vacancy rate for retail or restaurant space, if not higher, depending on where you're at in the country. And you're going to probably see a higher vacancy rate on average, but that could be 20 or 10. 20% when it's more concentrated and roughly 10% outside the concentration levels. I mean, what you're going to see is cities that have a younger age population where they don't mind walking. Hey, great, you'll see a lot of those restaurants, bars probably do well. Well, not well, nobody's doing well, but recover okay. They're going to be willing to walk with less amenities, less restaurants, less facilities around them. You're expected to see rents on commercial properties drop at least 10.5% by year end, and that number going to increase into 2021, another 4 to 5%. So if you're a landlord on the commercial side of property and you're getting $1,000, you need to expect that market rent on your property is probably going to drop to $850 or whatever, 80% of what you could be pulling in, and you're going to have to expect to drop your rates to be competitive. There's a wave, immediately there's talking a big wave about banks are getting a lot of phone calls and landlords are getting a big phone call the first month to recalibrate rents, long-term leases. You're going to see a lot of stuff there. We know that delinquency rates triples in the U.S. commercial market as well, not just in Seattle, but all across the United States. You're seeing a lot of commercial mortgages really hit that bad spot. All right. And it's an opportunity for real estate investors. I mean, what we have found is that a lot of the, beforehand, there was a lot of these CMBS, all these big funds that were going in and finding this, but that has changed for the last couple of years. You had a lot of banks where a lot of banks came in and financed a lot of stuff. Over 53% of the loans out there, 53% of the loans that are in distress were issued by banks. Okay. And it's only a tip of the iceberg of what we see in default out there. There's a lot of distressed banks. And you look at the loan to value ratios, what they're lending at 70, 65, 63%. Banks have financed this stuff, and it's going to be a bigger discount to get it off their books. Okay. And you've got to be flexible in opportunity. As they say down here, you can step in and start providing capital to buy out some bad loans or work with current borrowers to try to reposition the property if you can. That's the opportunity for a lot of people. Hey, do I evict the person I have in here right now and try to find somebody in, or do I just try to work with them to keep them in the property, knowing that if it goes vacant, it's probably going to be vacant for a while. All right. If you've been tracking all this stuff, there's billionaire investor Carl Icahn who talks about it's going to blow up. And this was actually in March of 13. Obviously, it was right about this time, and he was 100% on fact. Over $50 billion was lost in the CMBS market, basically in a short time frame, about a week. It's going to be worse than 2008, he says. He's been shorting a lot of his commercial stuff for a while now to have the cash available so that he could step in and buy some stuff at record prices. Another bank I talked to this day said, listen, man, he goes, I've seen more deals in the last 90 days that have just been phenomenal deals at discounts and pricing than I saw all of last year. And he goes, the real price point to look at was that sub $2.5 million value mark. All the big boys, they don't want to waste their time anything below $5 million for the most part. So there's a big amount of distressed debt, $2.5 million balances that the banks finance, but they're struck down. They're willing to work with you guys out there. We all know shopping malls are going the way of the dodo bird. Seattle has experienced a very steep decline in commercial real estate sales. The sales have dropped, fallen off, decreased by 65% year to date compared to last year. And that's a sad, sad thing. We could go on and on about negatives and things falling, but let's talk about the opportunities. Okay. We all know it's kind of a rough time out there, residential commercial, but where are the opportunities? Are there opportunities to be in foreclosures and REO properties? No. If you're trying to do that, that's been your game, you're going to have to wait 12 to 18 months to see stuff. And I know that's not exciting at all, but that's the case. It's going to kick the can down before we have to foreclose. We don't want to foreclose. We want to be the bad guy. Well, we can get bailed out. We'll kick the can down the road. That's not the case. Does it make sense to be in fix and flips? No, because the inventory is just not there. We know Seattle's been a super competitive market when it comes to fix and flips, with the median price continuing to increase and starting to dip now. Doesn't make sense to do that because even hard money lenders, you don't want to finance something, at 70, 75%, especially the hard money lenders. They don't want to do that anymore. They're getting a lot more tighter. So money's tightened up a little bit that way for you using mezzanine financing. Rentals, we know it's not a good place to be a landlord in Seattle. Does not make sense right now to be a landlord. All right. Now, what does make sense is in the debt game. If you can buy non-performing notes, you can buy on the residential commercial side, buy it cheap enough, it's going to give you some flexibility to negotiate with the tenants, whether it's commercial property, the renters, if it's a residential property. That's the opportunity. You're going to start seeing, we're already starting to see some residential notes starting to peak its way, but we're going to see a much more of it in the fourth quarter. Why the fourth quarter? That's when banks are moving most of their stuff in the fourth quarter anyway. So that's going to give them another 90 days to evaluate the portfolio. Hey, what's the bank's going to do? Or they can be bailed out. Can we hold on to this? Has this borrower express interest in staying in the house? This gives them a whole time to look at feasibility studies and look at that stuff. But you will see a lot of stuff that they want to get off their books. I talked to two banks recently, one in Washington State, one in Wisconsin, just the other day. And they're both like, we got to move. We got some borrowers on our books that we have to move off. Even though they've been great for us, we got to get them off their books. I'm like, well, that makes no logical sense. And you're going to see commercial notes, already starting to see commercial notes hit the market right now because they're not government backed. You're already seeing things taking place. I saw, if you've been on this before, maybe you heard me talk about Hotels specifically. There's hotels in New York City, $260 million loan on a 1,300 room hotel right across from Central Park, selling for less than 20 cents of unpaid balance. 260 million selling for 50 million or less. You're going to see some of those big discounts out there. Now, yes, 50 million is a big bite for somebody, but think about that. That's on the bigger side. There's more smaller stuff than there's bigger stuff out there. So it's a huge opportunity. You're going to see people pivoting. This is a popular thing, is taking your hotels that have been distressed. We're going to see a huge wave of hotels in distress, taking it and converting it into residential rentals, not hotels, but rentals. This is a great article came across on this spot property in Chicago, One Arlington Place, actually at Arlington Heights. They did that and converted that. Our buddy Garrison Gilbert, one of our students, is doing the same thing on a property in Pennsylvania, taking a 55-room hotel turned into 42-bedroom apartments. That's a big opportunity. We all know there's hotels everywhere, especially in desirable cities, and a lot of them are struggling, or a lot of them on the outskirts of smaller, I won't say the name brand, the flagged hotels, but there's plenty of non-flagged hotels out there. Those are the ones that don't have the deep pocketbooks with the parent company about there. So there's some great opportunities there for you. Are there banks in trouble in Washington State? You better believe there is. All right. One of the things that we track on a regular basis is Bauer Financial, and that they're a bank and credit union rating company that looks at the bank's numbers, their FDIC, their quarterly reports they file, how much in defaults they have, what type of reserves are they going, and it really ranks them on a star rating. Now, it's hard to tell. There's a lot more. There's thousands of banks that lend in Washington State. We know that. There's a lot of banks out there, okay? But when you just pull those that are in Washington State alone, there are 20 big banks with 5 branches or more based in Washington State. Now, what do their numbers look like? Well, we know it looks pretty good right now, but out of that 20, there's $238 million in loans that are at least 90 days plus in default, and more joining that number every week, okay? $238 million in 90 plus accrual loans in default. On average, it's only about 2.26%, less than 2.5% of each bank's portfolio, but that's still 2.25. That number is going to increase of each bank. Now, the thing about that, if you look out of that number at 238 million, there's 89 million. About a third of it is in single-family homes. That means roughly each of those 20 banks has, on average, $20 million in residential loans that are in default. That number, as we know, is going to increase. Yeah, it's a small mark now, but it's going to get worse as this drags out. Now, two of the biggest offenders is one is Home Street Bank. They've got 78 branches throughout Washington State. They've got $46.7 million in single-family loans that are at least 90 days in default. And you may recognize their branding, but the next one is Washington Federal Bank. They have 26 million in defaults, and they've got 235 branches. Now, you're not going to buy from, yeah, that's right. You're not going to buy from HSBC or others, some of these bigger banks, Bank of America, Chase. They're not going to sell you one-offs, but there's a lot of smaller lending institutions, regional banks, regional lenders out there that have stuff on their books. And this is one of the beautiful things I love looking is this gives me, you pull in this list, I can target the banks that are in default. I can say, I know you've got this much in default. Are you selling it, or what the heck are you trying to do with it? Let me help you get this off your books. Oftentimes, since we can step in and close, it's easier for us to do that. Now we can become the bank. Now we can do some things to negotiate with the homeowners, and it saves us 6 to 12 months before it ever ends up going to foreclosure and going from that. So why buy distressed debt? Why would it be in your best interest to be a note investor in buying distressed debt in today's market? Well, everybody wants to be the bank, okay? You can start getting deals now instead of waiting to the very end and letting all the other investors fight over the scraps, all right? You don't have to wait. A lot of times we're buying distressed debt. We get it repurposed or re-performing. It never ends up hitting the foreclosure markets, never ends up hitting the MLS, okay? We can buy it at substantial discounts based on location, foreclosure timeframe, value, condition, et cetera. Whatever's going on with the property, we can often negotiate at substantial discounts. And we're talking 30 to 70% off of what's owed. Sometimes more, depending on what the situation is. And I like controlling the asset. If I can buy a loan at 50 cents on the dollar or less of what's owed, that gives me enough flexibility to work with the existing operator, existing tenant, existing borrower to try to work something out. And there's a whole variety of strategies, loan reinstatements, modifications, Short sales, short payoffs, foreclosures, loan sales, deed and lose, cash. As a commercial note investor, I have the right to start collecting rents if the borrower stops paying the bank. Me becoming the bank, I have the right to say, cut the owner of the property out and go direct to the tenants in receivership and start collecting the rents. Done that several times before in the past. It's a great clause by commercial note. You can take over the note, take over the property, turn it into cash flow, performing note if you need to. If you want to take over the property because you like the property, you want to put something into it, great. Trust me right now, vacant commercial deals are going to be very cheap if they've been vacant for a while already, or if they've newly distressed tenants that have moved out. Take over the property, do what you want. It will be one of the biggest wealth transfers here over the next 12 to 24 months. And it's up to you if you want to dive into this, okay? Other advantages of note investing over traditional other investing, hey, we're not spending thousands of dollars each month doing direct mail. We don't mail postcards or letters. We're not hoping to get one borrower to reach back to us with one deal and start the process all over again. Screw that. We target banks, lending institutions so that we get stuff on a regular basis. Regular deal flow, okay? And if you have emails, you can email. If you've got a LinkedIn profile or you're not afraid to jump on the phone, those are the three biggest things. Having a phone, an email, and a LinkedIn profile, those are three of the easiest ways for us to find deals. And we've been teaching people how to do that. Been doing this for years, decades, over a decade. I won't say decades now, but at least 10 years now, using those three big staples, okay? Like I say, one source leads to regular deal flow. I've had banks that send me their stuff every quarter, every 6 months. And it's not just one property. I can cherry pick the best deals for my own portfolio. All right? I don't have to try to squeeze an ugly deal, ugly square peg into an even uglier round hole. If the deals don't make sense, I move on to the other bank because there are thousands and thousands and thousands of banks out there that have thousands and thousands of deals. If you want to buy in bulk, great. Put a couple of deals together, get better pricing. You can do it with residential commercial assets. There's a lot of opportunity out there. And the thing is, you don't have to have the own money yourself. There are plenty of other investors out there that have millions, if not billions of dollars sitting on the sidelines that are looking for deals, great deals, to put their hard money to work. And here's the thing, everybody. In 2010, we peaked at 15 million homeowners underwater. 15 million homeowners underwater. That number we're going to get pretty close to. And that's not counting the commercial deal flow. How big a piece of the pie do you want? And you can make a lot of good money living off the crumbs of the bigger banks out there. Been doing it for years and helping a lot of people do it for years. So a lot of people, the biggest thing is, okay, Scott, there's deals, but I ain't got my money. All right? I ain't got no money. I'm a defaulted borrower. Okay, I get that. There are plenty of investors out there for capital, guys. $9 trillion in retirement funds sitting on the sidelines looking to be invested. Out of that, in the Seattle area alone, we pull the numbers on this, we have access to this stuff. There are 35,000 investors just in Seattle alone that have an IRA, an individual retirement account, okay? Out of 35, 23,500 of them had at least 150 or grand more in their accounts. Most of those probably making 0%, making very little on their money. Think about that. 23,000 people have 150 grand or more in their accounts making zero. And if you were to find a deal and offer somebody a 3, 4, 6, 7, 8, 9, whatever, 10% return on their investment for 12 to 24 months, short term compared to other things out there, you don't think they'd be willing to jump on board if you knew what you're doing, or even had a team out there if you found a deal that could help manage that deal for you? All you got to do is go find the deal from the banks. Yeah, a lot of them will say, yes, sign me up. There are roughly 29,000 active real estate investors in the Seattle market alone. So go find a deal. Go find an investor, put the two together. Be a deal architect. There's plenty of real estate investors out there in your backyard. Heck, I guarantee you probably throw a stone, you probably hit 2 or 3, okay? A lot of opportunity in the Seattle market like there is in other places across the country. The reason I bring up the statistics is I don't want you to think that you're alone. There's a lot of investors, there's a lot of private capital, a lot of money, and if there's a lot of deals, you just got to put yourself in the middle of it to go find that stuff. And do you want to be at the bank or do you want to be a borrower? And everybody is in the note game. You're either the borrower or the banker. Everybody's in the note game, but unfortunately, most people are on the borrower side where they got money going out. They're paying to their car loans, they're paying to their student debt, they're paying to their mortgage. They don't have anything coming in. And trust me, you want to be the bank, because the bank always wins, ladies and gentlemen. So they're the biggest companies. The banks are in the fix and flip game. The banks are in the property management game. The banks are in the paper game. That's why they take investors not making anything on their money and arbitrage it. We all do this. If you've got a savings account, oh, we'll pay a 0.1%. Well, they go out and lend that money at 6, 12, 20%. We'll arbitrage that. If they're paying you 1% and they're lending out at 5%, that's not a 4% increase, and that's a 400% profit margin to them. If you buy a note and can work it out, you buy it at 50 cents on the dollar, you had a 200% return on your money. If you only got to pay 6%, or really an infinite if you're using other people's money. So how do you tap into the tsunami of deals? There's a lot of ways to do it. I've been teaching successful real estate investors how to invest in notes since 2010, 10 plus years. It's hard to believe that now. I've been teaching investors about real estate investing since 2014. I've helped thousands of investors purchase their first non-performing note. Well, it was either as non-performing or performing notes. We helped a lot of people do a lot of amazing things, whether it's residential, commercial. I've done both. I got started in commercial deals, involved in the residential, so always looking at residential commercial deals all the time. And you can do it whether you're looking for cash flow or you're looking for asset growth. You want to add things to the bottom line. Hey, great. Whatever your cup of tea is, I don't care. There's opportunities out there. You can buy one off or you can buy in bulk. We've seen trades anywhere from as little as like 25 grand on average, all the way up to several $1 million. Now, I've bought notes for as little as $7 before on a piece of crap property that I flipped for 5 grand. All right. I've bought one asset all the way up to 185 assets as part of a pool before. There's opportunities out there and things that you can really make happen. And I don't care what your credit is. The bank doesn't care what color your skin is, what your sex is, what you wear. They don't give a rat's ass if you've been through ups and downs. We all have. What they care about is you don't need credit. You don't need your own funds. They're not going to seize it. If you've got other people's money to fund your deal, that's all that they care, that a wire shows up. And you can start doing this type of investing with emails, LinkedIn profile, and a phone. And you can do a lot of this. So whatever your focus is, whatever you love, single family homes, apartments, hotels, mobile home parks, retail office, self-storage, but whatever it might be, medical office, residential living assisted, whatever it might be, there are deals in all asset classes out there for all of you. And you can create win-win stories across the board for everybody involved. Not only just you, but your investors, the banks, and also the borrowers as well too for you, everybody. So we've been helping people stay in their houses for over a decade. And there's nothing greater than having the borrower show up to a closing table to sign off on a loan mod or loan forbearance agreement, and they shed tears, and you help them carve off 23 years of their mortgage by helping to work with them to modify. This is a case of this one borrower right here. I could go on story after story, but William and Sheila, when they lived in this house for 18 plus years, they took out a loan, pulled some cash out, did some repairs, pay off some bills, and then the market crashed on them, and then he got sick. And we stepped in, and we saw their note was part of a portfolio we were buying. We looked at the note, saw that they've been trying to do a loan mod for 4 years to stay in the house. I knew a motivated seller when I see one. Picked up the phone, negotiated with them immediately, dropped their interest rate to 0%. They brought a little money to the table, paid a little bit extra above their existing payment each month, and they paid off their mortgage in less than 8 years versus being stuck into that for 30 years. That is a beautiful day when you're able to carve hundreds of $1,000s off of somebody's debt and helping them stay in their house and be a win-win. And you make money too, made plenty of good money on that deal. And it was just an absolute beautiful thing. And those are the kind of stories that I love telling, because you have the opportunity to do that right now. You have the opportunity not only to make money, which is a good thing, but also help people. And the U.S. needs people helping people these days. You can do it on a big level or do it on a small level. I don't care what you want to do. Most people start small and work their way up, kind of like Gene did here. Gene started in Indiana, where he's from, Elkhart on the north side of Indiana, was a hot shot driver, driving things across Indiana and Illinois, buying a little bit of real estate here and there. He was really kind of scared, wanted to stay in his one market there. When we met him, we kind of pushed him. We got him doing things, and now fast forward a couple years later, he's got over 13 million invested in the market out there from other people's money, closed on a couple hundred deals as well, making a big difference. And how to start? Learning how we taught them the basics and showed them how to rinse, repeat, put the systems in place to make a ton of money. It's a great story. I love it. I'm very proud of what Gina's done. I'm also really proud of Laura Blanc, who's one of our rock stars as well. She's a local Texas girl here, lives south of Austin, just moved to Maryland, just bought her dream house that she dreamed of living in since she was a little girl, and absolutely done an amazing job. She got started a little slow, bought 2 notes, was really working on that, need a little kick in the butt. We helped her out with that. She went and bought 2 notes, done 14 notes, and then at the end of the first year and a half, she was up to 75. She may be over 100 now. She's getting ready to close, though, on a portfolio of 148 performing notes at 53 cents of what's owed on them. They've all got equity. It's a phenomenal deal, $4 million trade, and I'm so proud of what she's done. Complete 9-day difference, because she was like many of you guys out there as real estate investors, trying to hustle, trying to wholesale, trying to flip some deals, trying to do some small stuff, whatever they could with a tool belt. Screw that. That's one of the biggest things that I struggle with, is so many real estate investors try to do so many things without being focused. And if you stay in your niche, the riches are in the niches, everybody, and note investing is a niche. You just ask Keith Collins here out of Ohio. Keith is a great guy, great experience. Spent a lot of time working in local governments. I think he was mayor of a small town at one point, but done a lot of stuff. He really saw the value in the note business, sunk his teeth into it. And I got an email from Keith just the other day saying, Scott, me and my wife are going to make 7 figures this year because of what we've learned from you and what we've done in buying the debt, working it out. We're going to keep people in their houses. If they won't work with us, then we do go the foreclosure route. But he's always trying to keep people in the house, and I think that's a beautiful thing. So love what Keith and his wife are doing. Phenomenal. But I don't want you guys to think you have to have 20 years of experience. You don't have to do that. You could have no experience and still do things and make great money in this business as long as you do the things that we teach you to do. Just like Rafael here. Rafael's from San Diego. He's a business owner, or was a business owner, entrepreneur in San Diego with a car detailing business that obviously when nobody's driving and they're stuck at home, they're not going to pay for you to come out and detail their car. So he had to lay off 15 employees and try to make something happen. Luckily for him, before this all happened, back in December, he started taking our training, started learning from us. In his first 60 days, he bought 5 deals, bought 2 deals in really the first week and a half, and turned those 2 that he bought into reperforming notes, bringing in on an 18 to 20% cash and cash return on that stuff with his own money. Is phenomenal. The other 3 he bought, he's selling 2 of them, making a nice profit. And then the 5th one, the last one, he's still figuring out what he's doing with it. But he's done a great job. No real estate experience whatsoever. We taught him what he needed to know. He tapped into our network. He tapped into our podcasts and videos, and then spent some time with us and done an amazing job. So like I said, I don't care what your experience is, what your age is. I don't care what kind of country western song you've been through, been a default, been distressed, gone through a bankruptcy, short sale. I don't care. You choose. You can sit there and curl up in the fetal position and cry and rock about better times, or you can make your better times happen now. We are all in control of our own future and our own destiny. And you have to ask yourself the question, hey, do you want to do something that can really do some good and make some money? Or you want to sit here and keep waiting for the next opportunity? The opportunity is now, everybody. Just like the hundreds of other real estate investors that we have helped, other students of ours have closed on big deals and done amazing things, not only for their own bottom line, but for their family, their future, their investors, and the neighborhoods across the country, everybody. We do it in a variety of ways, but one of the best ways to do it is to attend our one-day note weekend training. That's what a lot of people start with. It's our nuts and bolts training. It's a one-day kind of mini course that we teach, 9 a.m. to roughly 2, 3 o'clock, or 4 o'clock. Depends on how many people are there. More questions to ask. You get yours truly, not 40 different speakers pitching to something. Me going through the note business, and as our students call it, it's the Cliff Notes version of note investing. You're not going to learn everything in a 3-day class. You're not going to learn everything in a 1-day class, but I go through and give you the nuts and bolts. It gives you a way to kind of dip your feet in the pool to see if that water is warm and you want to dive in. If you want to dive in, hey, we got other opportunities, but this is a great way for you to get started for just $49. Normally it's $99. We've cut the price in half to help it make it a little bit more affordable for people out there. Like I said, it's me. You get the replays. It's always the 3rd weekend of the month for the most part. We've got one in July. We got one in August. We got one in September. If you can't make the one that you sign up for, we can bump you to the next one. If you can't make the full day, guess what? Great. We record it so you can catch the replays on the Sunday. We go live via Zoom on Saturday. You can learn from your home or office or wherever, and then catch the replays the next day and later on. We also like to throw in some other things, but a lot of people ask what we cover. What can you cover in one day? Well, first off, we're going to show you where to find these deals. We're going to talk about what to say, what not to say to the banks, how to build a list that you can market to on a regular basis to find deals. We're going to talk about how to raise private capital, how to find investors and use other people's money, OPM, to take these deals down. Whether you want to do a one-off, a two-off, or start putting bigger money together to take big deals together. We're also going to share with you the different exit strategies that are available to make money. There's a whole variety of 10 different strategies out there in the note space, and we'll discuss those. We'll also talk about the different vendors and team members. We'll actually have some extra video training for you guys to be able to watch outside of Note Weekend. It's included, so you can watch that and learn about the vendors. We'll learn about servicing, special servicing, and other things that are involved as well. We'll talk about some of the different loan trading platforms that you can tap in right now. You don't have to wait 90 days. You can start looking at deals right now and breaking down due diligence to start working on these deals to hone your skills and craft now. Don't have to wait till the end of the year. We'll also talk about a lot more things. Like I said, I stay there and answer questions till the very end. And then the beautiful thing is, hey, if you want to sign up for our 3-day workshop, we apply that $49 towards that cost of a virtual workshop. Or hey, at the end of the first session, you're like, Scott, I don't think this is it. Hey, no skin, no harm, no foul, no skin off my chin. We'll refund you back your $49 if you don't feel like it's for you and let you go on your merry way. If you go to noteweekend.com, you can actually see the schedule broken down half hour by every 30 minutes. We also include a manual for the event, an 18, actually it's probably closer to 20-page manual because we're updating and adding some new things to it. But a manual go along with it, and it's all for just $49, ladies and gentlemen. It's not here. Trust me, I'm not getting rich off of $49 by any means of fashion. I just want to help create an army of note investors who want to do some great damage to the bad taking place out there right now. I want to hit my mission of helping create 10,000 investors that can do some big things here in the next 12 months. And so I love to throw in some extra bonuses. Obviously, the one-day Note Weekend training, normally $99, that's $49. One-day calling banks training. This is where you get to listen to me call banks, be a bird on the, fly on the wall, listening to me to have these conversations with the banks. We do it live for 4 hours during one day. Hey, you know what? We record that, so if you can't make it, you can watch that. That's included in there. We include the most recent Bauer financial list for you guys to take down and take a look at. Over 2,000 banks and institutions on there with names of the presidents, numbers, and their rankings of where they rank, whether it's a 0-star or a 5-star bank or what their reserves are, who's got what. That's included. That's what would cost you $360 to buy that yourself. I mean, that alone is worth the $49. You get a 30-minute one-on-one phone call with me after the class. I like to sit down and talk with people. Hey, what's your next step? Where do you want to go? Is this a fit for you or is it not a fit for you? Or help you kind of hone in where your message and where your direction you're going. The worst thing people do a lot of times, they try to do much. Hey, let's focus on one thing and get that down before you do anything. We like to throw in the replays, included great. If you've got a spouse that wants to jump in, great. We'll let them come and attend as well. And then we also, like I said, we've got a private Facebook group that's about 900 members strong. Great place to network. Great way to connect with other note investors, to find vendors, realtors, other things that we use in our business to make things happen. All of this, like I said, it's over $1,000 in value for just $49, everybody. Normally $99. We dropped it to $49. No nonsense pricing to help you get your stuff started. Like I said, the cliff notes of note investing. No, it's not a pitch fest. It's literally going to go through step by step with you for a day to get your feet started on things. Now, why should you do this? Well, obviously, if you're looking to help yourself, borrowers and investors out there, this is something you should sign up for. If you're looking to make money helping people solve problems in a crazy world today, you should sign up. If you're looking for an opportunity to truly build wealth, help you accomplish your dreams and goals, hey, this is the opportunity for you. I'll tell you this, we all know distressed borrowers. We all know distressed businesses. You just have to look to see people that are struggling. Everywhere you turn, I don't care if it's in your neighborhood, your zip code, your block, your city, your state, your county, we all know people that are struggling. Why not help people? Why not learn what can go on and at least advise? I spent some time today advising a lady in Arizona on a deal. I spent time talking to a lady in Florida yesterday on another deal. Hey, great. I'm just giving them some advice on some things. We see enough deals, and that's the beauty of why we're putting this together is I want to create, like I said, an army that I can feed deals to. As we see deals in your market or the market you're interested, we want to feed deals to you as well. And there's nothing greater, nothing I get more joy from than helping someone overcome an obstacle or achieve a goal or dream that they thought was impossible. I'd love for you to be a part of that. All right, everybody. So once again, love for you to get signed up. Noteweekend.com, everybody. One day, live stream on Saturday. Live streaming on Saturday, restreaming on Sunday for you guys. Ask questions live. It's yours truly. $49, 9 a.m. to 3 or 4 o'clock. You can go to noteweekend.com, see the next schedule, see the full schedule for the day. And I would love to open up if there's any questions out there for you guys that are watching this right now. I know it covered a lot of information. A lot of information out there for you guys out there, and I want you guys to take advantage of it. But please, guys and gals, this deal's not going to last for you. We're doing a special thing as we're doing this Note Nation tour. $49, guys. We'll also throw in a copy of our ebook, How to Buy Notes at Distressed Debt, and get things rock and rolling for you. But once again, everybody, thank you so much for being a part of Note Nation. Thank you for being here. Hopefully it was valuable. Spent a lot of time on these presentations going through each city, finding information, finding the valuable numbers. And it's ever a flowing, organic beast, as we know the market is. You might as well take advantage of what's available out there because nobody else is watching out for you. You need to watch out for yourselves. So hopefully we'll see you at Note Weekend sometime soon. Otherwise, have a great evening, great morning, great afternoon, whenever you're watching it. Feel free to ask your questions. Like I said, in the chat roles, in the comments, we'll be glad to answer those as well. But otherwise, be safe out there. Have a great day, and we'll see you all at the top, everybody.